Hello everyone and welcome back to these sessions on economics for finance. As per your ICAI study material, we are into the fourth chapter and that is titled as international trade. And this is the second lecture on international trade where we are introducing the second unit of this chapter, which is titled as the instruments of trade policy. Now before I enter into the whole point of instruments of trade policy, first of all I must explain you what exactly do we mean by trade policy. First of all, the term trade over here is necessarily meaning what? International trade. So, and policy, who is going to formulate policy? Not people like you and me, not importers, not exporters. It is only and only the government which is going to formulate the policy. So if you can recall, in chapter 3 we have learned everything about monetary policy. Chapter 2 was all about fiscal policy. Chapter 4 is all about trade policy. So what will be role of government in international trade? If you have understood all the earlier topics of economics that you have discussed with me, I am sure you will understand this core objective in one go. See, we have talked about trade imbalances. We have talked about balance of payments, correct? In monetary policy chapter, in demand of money and supply of money chapter. So just try to link up. Every country, and that's the same case with India as well, we would want more and more of exports and less of imports. We definitely would want that others should depend on us, but our dependency on others should be as minimum as possible. That will be primary objective of government, and therefore government will come up with policies after policies, and they will formulate all these policies in such a manner that this core objective of trade imbalance can be overcome. Why I am saying trade imbalance can be overcome? If you look into one thing, we have a little bit of excess of import as compared to exports. As a result, our demand for foreign currency is more than the availability of foreign currency, and therefore we are always in short of foreign currency reserves, and therefore government of India is always trying to reduce this trade imbalance. At least let the exports and imports be at equitable level first. Let's attain that objective first, and the next stage will be to enhance more and more of exports. Now not just this, if you could look into, our government is trying every bit to look into that other countries should invest in India, because you know developed countries are having abundance of capital. In India we find abundance of labor, because typically when we always complain about population of our country, that because of so big population the resources are getting divided, but have you not noticed that big population has a big strength, that is huge labor supply. Now in the first unit of international trade, while we were learning theories of international trade, haven't you come across a theory where there could be countries which are labor intensive but they have shortage of capital? On the other side, there could be countries which are capital intensive but shortage of labor is their problem. Now India is a country where there is shortage of capital and there is abundant supply of labor. So products where the labor cost included in the product's cost is going to be significant, it is good to use cheaper labor, definitely a high quality labor but a cheaper labor, and that could be made available in India. So what we can do is, capital intensive countries, that is countries having abundant capital supply, like say for example the United States, what these countries should do, they should take up their raw materials, supply the materials to Indian nation, let country as India convert this raw material into finished goods and give it back to the United States. What will happen? The processing cost in India will be substantially lower than what it is in the United States. As a result, our Prime Minister has been focusing on one motto: Make in India, Digital India. Now, what are these objectives? These are objectives of trade policy. Make in India is what concept? That boss, you have materials, you want output, your labor is expensive, but we have abundant supply of labor, we have cheaper labor but a very good quality labor. The processing cost as a result will be at minimal. You just give us the opportunity to convert your raw material into finished product, and we both can have win-win situations. You get the product at a low cost and we will get our labor force sufficient employment. We can provide sufficient employment to our labor force. So it's a win-win situation, right? That is what we call as objectives of trade policy. So first of all, meaning of trade policy, and there are various objectives of trade policy. So what do we mean by trade policy? Policies formulated by government of any country to regulate the imports and exports. So if you want to promote imports or exports or restrict imports or exports, it is trade policy that will have to play its role. Now, always promoting more and more of exports is also not good. For example, there may be severe shortage of certain types of materials in India which you should not try to export more and more. These days, the most recent example could be export of coal, which should be avoided, correct? On the other side, in earlier sessions I have told you that if it is agricultural produce or some kind of fruits etc. which are popular across the world, best example could be mangoes, more and more of such products should be exported. So there will be certain products where exports need to be restricted and certain products where export needs to be promoted. Now, trade policies are formulated by government to handle all these issues, and therefore we can understand what is the meaning of trade policy and what are the objectives of trade policy. So based on what we have just discussed, let us write up notes on meaning of trade policy as well as objectives of trade policy. So based on what we have just discussed, please write under the heading trade policy. Trade policy encompasses all instruments that governments may use to promote or restrict imports and exports. Trade policy also includes the approach taken by countries in the trade negotiations. So please write up the meaning of trade policy and then I take you ahead. Alright friends, once you have finished writing the meaning of trade policy, let us move ahead and continue writing further. Major objectives of trade policy. to provide a stable and sustainable policy environment for foreign trade in merchandise and services, to link rules, procedures, and incentives for exports and imports with other initiatives such as Make in India, Digital India, and Skill India to create an export promotion mission for India, to provide a mechanism for regular appraisal in order to rationalize import and reduce the trade imbalance. So please write up these objectives and then I take you ahead. Alright friends, if you have written these 3 points over here already, let us move ahead and continue writing the further objectives of trade policy. Next point you write as to allow import of technology and equipments which may help in establishing new industrial enterprises, produce new product and adopt a new process for higher production levels, to accelerate the country's transition to a globally oriented, vibrant economy, to deriving maximum benefits from expanding global market opportunities, to provide consumers with good quality product at reasonable prices through regulated imports of such products. So please write up this much and then I take you ahead. Alright friends, I'm sure you have finished writing this whole thing. Let us move ahead and write up the next heading as use of tariffs as a policy instrument. So please don't forget one thing, that the title of this unit is Instruments of Trade Policy, correct? So what could be an instrument of trade policy? What can bring the impact on trade and imports and exports? Tariff could be one big instrument. Now what exactly do we mean by tariffs? Tariffs are taxes levied on imports and exports. So generally on exports you don't find countries levying duties or taxes. So tariffs are basically custom duties, or you can call it as import duties. So what happens if you levy heavy duty on certain types of imports? Obviously what will happen, people will tend to have less and less of those imports. Where you want to keep the imports liberal, you may have either zero tariff or very low degree of tariff. As a result, you can control the imports. By giving incentives on exports, you can promote more and more of exports. When you don't want certain types of exports to be made, where you want to restrict those exports, you may levy taxes or tariffs or export duties on such exports. And as a result, you can find that tariffs could be one major instrument of international trade policy, or we can simply call it as an effective instrument of trade policy. So let us do one thing, let us write some notes on the same, and I will just expand the screen for you. And here we write further, a tariff is a tax imposed on the import or export of goods. In general parlance, however, it refers to import duties charged at the time goods are imported. Tariff is also a policy tool to protect domestic industries by changing the conditions under which goods compete in such a way that competitive imports are placed at a disadvantage. In point of fact, a cursory examination of the tariff rates employed by different countries does seem to indicate that they reflect to a considerable extent the competitiveness of domestic industries. So please write up this much and then I take you ahead. Alright friends, once you have finished writing this much, let us move ahead and write up the next heading as forms of import tariffs, and we begin with the first category of tariff, that is specific tariff. Now various forms of import tariffs you can find as prevailing, and one simplest form of tariff could be a specific tariff. Now a specific tariff is levied on the quantity of imports. For example, it is levied as a certain amount in terms of per kg or per ton or per liter of that import quantity made. For example, if you have an import and that import is of a certain type of motor vehicles and the duty levied is rupees 5,000 per unit of that motor vehicle, then that is what we call as specific tariff. But there is a big disadvantage of specific tariff. Specific tariff will be charged at 5,000. I mean 5,000 in this particular example what I am conveying. It all depends on the tariff rates. So it will be a specific amount that will be levied on each unit. Now what may happen if the value of that unit is large or small, the amount of tariff will be fixed. That is the disadvantage of specific tariff. Logically, tariff should be charged at a certain percentage on the import value, and I'm sure you are convinced with this concept, and that is why in India we don't have the policy of specific tariff. We have all the import duties majorly covered under the head ad valorem duty. Ad valorem duty is a duty levied on import as a percentage of the import value. So that is the main form of duty that prevails in India, apart from some other forms. And what is definitely not prevailing in India is this first heading what we have written, that specific tariff or specific duty is not prevailing in India. So let us first write some short notes about specific tariff and ad valorem duty. So keep your focus on the screen while I provide you these notes. A specific tariff is an import duty that assigns a fixed monetary tax per physical units of the goods imported. It is calculated on the basis of unit measure such as weight, volume, etc. of the imported goods. On the other side, the other type of tariff, that is ad valorem tariff, it is levied as a constant percentage of the monetary value of 1 unit of the imported goods. So the first one, the specific tariff, is based on the physical quantity. On the other side, the second one, ad valorem, is a tariff which is levied on the value. It is basically a percentage applied on the monetary value of the goods imported. So please write up the meaning of these two and then I take you ahead. Alright friends, I'm sure you have finished writing these two. Let us move ahead and write about other types of tariffs. Mixed tariffs. Mixed tariffs are expressed either on the basis of the value of the imported goods, that is an ad valorem rate, or on the basis of unit of measure of the imported goods, that is a specific duty, depending on which generate most income, and the best example could be cotton. So I'll exactly explain you what it is, but let me give you some notes first of all. Now, compound tariff or a compound duty, it is a combination of an ad valorem and specific tariff. That is, the tariff is calculated on the basis of both the value of the imported goods, that is an ad valorem duty, and a unit of measure of the imported goods, that is a specific duty. It is generally calculated by adding up a specific duty to an ad valorem duty. And for example, you can take example of cheese. Now guys, do one thing, first write up this much and then I'll explain you both of these and how to differentiate between the two. Alright friends, I am sure you have written these two. Now before we move ahead, let me give some explanation on these two and make you understand the difference between the two. First of all, we are talking about mixed tariff and the other one is compound tariff. Now many students may have some confusion. I'll give you simplified way to understand this. Mixed tariff is either or situation and compound tariff is and situation. That means when it is a case of either a specific duty or an ad valorem duty, either one will be considered as mixed tariff, and when it is constituting both of these components, that will be compound duty. So what happens when you are importing cotton? What happens when you are importing cotton? There will be a specific charge per ton and a certain percentage on the import value. Whichever is higher will be levied by government as import duty on cotton. So over there you compute tariff as per the specific rate and you compute tariff as per ad valorem duty, and you find whichever is higher for the government as revenue, that will be fixed as the tariff, and that is what we know or what we understand as mixed tariff. On the other side, when you are importing cheese, there is a certain amount which is charged on each ton or each kg of cheese purchased, and there is a certain percentage that is applied on the monetary value. Both of these are clubbed together and the charges, or I would say the taxes, are levied. So don't ever mess up with these two. Mixed duty is either or situation, whichever gives higher benefit to the revenue department or the custom department, and the compound is actually the aggregate of both. So where, you know, in costing you have learnt something like a semi-variable cost, partly fixed and partly variable. So this compound duty is that type, that is semi-variable cost type. So I have already given you time to note down this and you have written, and let us move ahead and write up the other forms of duties now. So the next one in the sequence is technical or other types of tariff. These are calculated on the basis of specific contents of the imported goods, that is the duties are payable by its components or related items, for example solar panels. Now let me explain a bit about this before I give you anything in writing further. So what happens in case of solar panels? If you could see, solar panels, they comprise of basically two components. One is the panel itself, which absorbs the sunlight, and the other one is the battery part of that, which is getting charged because of solar energy. So batteries are levied at a different rate. On the other side, the panel itself is chargeable at a different rate. That means different rates of duties when they are applied on different components of the imported goods. That is what we call as technical or other type of tariff. Now let me give you the other one in this sequence. So please first understand again the other one, that is tariff rate quotas. Tariff rate quotas, that is TRQs, combine two policy instruments, that is quotas and tariffs. Imports entering under the specified quota, that is quota portion, are usually subject to a lower or sometimes zero tariff rate, and imports above the quantitative threshold of the quota face a much higher tariff. Now this could be yet another way to control the imports. And how could you restrict the imports by fixing these kind of quotas? These are basically slabs. For example, up to a total value of rupees 10 lakhs, a certain type of import is free from any duty. That much import you make, it is free from duty. For example, you go to say the United States and you get a piece of laptop for yourself, 1 unit. So maybe that is exempted from any kind of tariff, because it is implied that you have purchased it and you have brought to India for your own usage. That is why what happens when you are traveling and when you land up at Indian airport, there will be custom authorities to investigate what all you have purchased, and you have to declare all what you have purchased from there, and they would see what are free goods and what are chargeable to certain tariffs. For example, if you have purchased gold for your own usage up to a certain limit, purchase of gold, generally people go to Dubai and purchase gold. So if you have purchased gold to a certain extent, it is not chargeable. It is, if it is falling in that limit, if it is falling in that free quota limit, there is no tariff leviable, or there will be very minimal charge. But if you purchase gold in bulk quantity, there will be a heavy tariff that will be charged, and this is what we call as tariff rates quotas, that is slab rates fixed. So I think I have not given you sufficient time to write down these. So first finish writing this whole thing and then I take you ahead. Alright friends, once you have finished writing this as well, let us move ahead and continue writing further. Most favored nations tariff, that is MFN tariffs. MFN tariffs refer to import tariffs which countries promise to impose on imports from other members of WTO unless the country is part of a preferential trade agreement such as free trade area or customs union. Variable tariff, a duty typically fixed to bring the price of an imported commodity up to level of the domestic support price for the commodity. Let me quickly explain both of these points to you. First is MFN tariffs. Now what happens, there are certain countries which are members of WTO. WTO is World Trade Organization. So if a country is a member of WTO and it is having an export-import relationship with another member of WTO, the tariffs between these two are regulated by WTO. So what happens, if there is a member of WTO dealing with another member of WTO, the tariffs will be MFN types of tariffs. On the other side, the variable tariff. So variable tariff, let me explain. Suppose in India, the manufacturing of cars are generally promoted, that we want Indian cars to run on Indian roads. That is why if you see on cars and motorbikes, if you are importing cars and motorbikes, the duty levied on cars and motorbikes is very high. Because we have technology, our country is also producing automobile, then why should we have too much of imports of this? And to keep that thing under a check, to keep that thing under a control, a heavy import duty is imposed. That comes under variable tariff. So one objective could be to restrict the import, other objective could be to let the cost matched with the manufacturing cost locally in India. Let me explain this point. For example, the manufacturing cost of suppose a certain electronic good is rupees 30,000 per unit. Okay, and when you are importing that, the manufacturing cost is 30,000 locally in India and the import value is just 15,000. What will happen? The tax department will be levying a duty of 100% on that 15,000. So 15,000 of import value, 100% tariff or 100% import duty applied on that, 15,000 plus 15,000, the total product value when it is landing to India, it is having cost of 30,000. This is basically to match the cost of that with the local manufacturing cost, and that is what we call as variable tariff. So these tariffs are again for imposition of certain types of restrictions on imports. So please write up this as well, and then I take you ahead. Alright friends, once you have finished writing this much, let us move ahead and continue writing further. Preferential tariff. A lower tariff is charged from goods imported from a country which is given preferential treatment over MFNs. These agreements are reciprocal. A lower tariff is charged from goods imported from a country which is given preferential treatment. Examples are preferential duties in the European Union, that is EU region, under which a good coming into one EU country from another is charged zero tariffs. So please write up this and then I take you ahead. Alright friends, I am sure you have finished writing this whole thing. Let us move ahead and continue writing further. Bound tariff. A bound tariff is a tariff in which a WTO member binds itself with a legal commitment not to raise it above a certain level. The bound rates are specific to individual products and represent the maximum level of import duty that can be levied on a product imported by that member. A member is always free to impose a tariff that is lower than the bound level. Once bound, a tariff rate becomes permanent and a member can only increase its level after negotiating with its trading partner and compensating them for possible losses of trade. A bound tariff ensures transparency and predictability. So please write this as well and then I take you ahead. Alright friends, I am sure you have finished writing this whole thing. Let us move ahead and continue writing further. Applied tariffs. It is charged on imports on a most favored nation, that is MFN basis. A WTO member can have an applied tariff for products that differs from the bound tariff for that product as long as the applied level is not higher than the bound level. Escalated tariff. It refers to the system wherein the nominal tariff rates on imports of manufactured goods are higher than the nominal tariff rates on intermediate inputs and raw materials. That is, a tariff on a product increases as that product moves through the value added chain. So please write up this much and then I take you ahead. Alright friends, once you have finished writing this much, let us move ahead and continue writing further. Prohibitive tariff. A prohibitive tariff is one that is set so high that no imports can enter. Import subsidies. An import subsidy is simply a payment per unit or as a percentage of value for the importation of goods, that is a negative import tariff. So basically prohibitive tariff is to avoid imports and import subsidies are to promote import. So please write up these couple of paragraphs and then I take you ahead. Alright friends, so once you have finished writing this much, let us move ahead and continue writing further. Tariffs as response to trade distortions. Sometimes countries engage in unfair foreign trade practices which are trade distorting in nature and adverse to the interests of the domestic firms. The affected importing countries, upon confirmation of the distortion, respond quickly by measures in the form of tariff responses to offset the distortion. These policies are often referred to as trigger price mechanisms. So please write up this much and then I take you ahead. Alright friends, so once you have finished writing this whole thing, let us move ahead and write up the next heading, anti-dumping duties. Now this is something very important. Over here, before you write anything, let me give you a complete explanation on anti-dumping duties. Now what exactly is meant by anti-dumping duty? Anti-dumping. So you would have noticed that countries like China, many electronic producing companies operating from China, they have tendency to make heavy exports to India and they supply these products at a very low price, basically to dump their excess production. So first of all, what they did to have economies of large scale production, they produced in huge bulk quantity. But because the local markets over there could not absorb that, they can just restrict the local sale and the major part of their production they push to countries like India, where their goods are literally dumped in our country. And what happens, the local manufacturers in India of competitive products, their cost of production is not matching with the price at which these goods can be imported. So one big reason everybody knows is China is a country known to make inferior quality goods. If it is made in China, 90% chances that it will be an inferior quality product. You know that, we know that. So these countries have tendency of dumping their own outputs to other countries. The best way to avoid that is levy a heavy rate of duty on such goods. So any importer in India willing to purchase these goods, there is anti-dumping duty levied, and the goods will be then imported only by levying a heavy rate of tariff on such goods. That is all what we mean by anti-dumping duty. So let us write notes on this important type of duty, and let us first mention that an anti-dumping duty is a protectionist tariff that domestic government imposes on foreign imports that it believes are priced below fair market value. Dumping is process where a company exports a product at a price lower than the price it normally charges in its own home market. To protect local business and markets, many countries impose stiff duties on products they believed are being dumped in their national market. So please write up these points, and then I'll give you some more notes on anti-dumping duties. Alright friends, once you have finished writing this much, let us proceed ahead and continue writing further. Dumping may be persistent, seasonal or cyclical. Dumping may also be resorted to as a predatory pricing practice to drive out established domestic producers from the market and to establish monopoly position. Dumping is an international price discrimination where the exporters deliberately forego money in order to harm the domestic producers of the importing country. This is unfair and constitutes a threat to domestic producers. So please write this much and then I take you ahead. Alright friends, so once you have finished writing this much, let us move ahead and write up another important heading, countervailing duties. It is levied on imports to offset subsidies made to producers of these goods in the exporting country. Countervailing duties are meant to level the playing field between domestic producers of a product and foreign producers of the same product who can afford to sell it at lower price because of the subsidy they receive from their government. Now this is again something very important. You may please try to first understand and then I'll definitely give you time to note it down. What happens? The way in our country there are incentives given for certain types of exports. Just imagine that the counter country where there are producers of certain products, that country is giving export subsidies to the suppliers over there, and therefore because these people got some subsidies, they are able to afford to sell such thing in Indian market at a low price. So what is happening? In India it is getting imported at a lower value, whereas the manufacturers in India are having high manufacturing cost. So the point is not that the foreign suppliers could be producing it at a lower manufacturing cost. The cost of their overall export is lower because of the benefit that their government is providing to them. How can we counter it? By imposing countervailing duty. So whatever their government is providing them as incentives, that much duty you levy on such goods so that the cost of those goods in India is fairly competitive to the domestic market, and that duty is what we call as countervailing duty. Let me give you time to note down this whole thing and then we shall move ahead. Alright friends, so once you have finished writing this much, let us move ahead and continue writing further. If left unchecked, such subsidized imports can have a severe effect on domestic industry, forcing factory closures and causing huge job losses. As export subsidies are considered to be an unfair trade practice, the WTO, which deals with the global rules of trade between nations, has detailed procedures in place to establish the circumstances under which countervailing duties can be imposed by an importing nation. For example, in 2016, in order to protect its domestic industry, India imposed 12.5% countervailing duty on gold jewelry imports from ASEAN. So please write up this much and then I take you ahead. Alright friends, once you have finished writing this much, let us move ahead and continue writing further. Now we talk about effect of tariffs. Tariff barriers create obstacle to trade, decrease the volume of imports and exports and therefore of international trade. Tariffs encourage consumption and production of the domestically produced imported substitutes and thus protect domestic industries. Producers in importing country experience an increase in well-being as an imposition of tariff. The price increase of their product in the domestic market increases producer surplus in the industry. So please write up this much and then I take you ahead. Alright friends, once you have finished writing this much, let us move ahead and continue writing further. The price increase also induces an increase in the output of existing firms and possibly addition of new firms due to entry into industry to take advantage of the new high profits and consequently an increase in employment in the industry. Tariffs create trade distortions by disregarding comparative advantage and prevent countries from enjoying gains from trade arising from comparative advantage. Tariffs increases government revenues of the importing country by the value of the tariff it charges. So please write this much and then I take you ahead. Alright friends, once you have finished writing this much, let us move ahead and continue writing further. Different non-tariff measures adopted by countries. Non-tariff measures, that is NTMs, are policy measures that can potentially have an economic effect on international trade in goods, changing quantities traded or price or both. Technical measures. Technical measures refer to product specific properties such as characteristics of the product, technical specifications and production processes. These measures are intended for ensuring product quality, food safety, environmental protection, national security and protection of animal and plant health. So please write this much and then I take you ahead. Alright friends, once you have finished writing this much, let us move ahead and continue writing further. Sanitary and phytosanitary measures, that is SPS measures. SPS measures are applied to protect human, animal or plant life from risks arising from additives, pests, contaminants, toxins or disease causing organisms and to protect biodiversity. These include ban or prohibition of import of certain goods, all measures governing quality and hygienic requirement, production processes and associated compliance assessments. For example, prohibition of import of poultry from countries affected by avian flu, meat and poultry processing standards to reduce pathogens, reduce limits for pesticides in foods, etc. So please write this much and then I take you ahead. Alright friends, once you have finished writing this much, let us move ahead and continue writing further. Technical barriers to trade. Technical barriers to trade, which cover both food and non-food traded products, refer to mandatory standards and technical regulation that define the specific characteristic that a product should have, such as its size, shape, design, labeling, marketing, packaging, functionality, or performance and production methods, excluding measures covered by the SPS agreement. So please write up this much and then I take you ahead. Alright friends, once you have finished writing this much, let us move ahead and discuss the next category, that will be non-technical measures. These include different types of trade protective measures which are put into operations to neutralize the possible adverse effects of imports in the market of the importing country. So first, by fixing imported quotas. An imported quota is a direct restriction which specifies that only a certain physical amount of the good will be allowed into a country during a given time period, usually 1 year. Import quotas are typically set below the free trade level of imports and usually enforced by issuing licenses. So please write up this much and then I take you ahead. Alright friends, once you have finished writing this much, let us move ahead and continue writing further. Price control measures. Price control measures including additional taxes and charges are steps taken to control or influence the prices of imported goods in order to support the domestic price of certain products when the import prices of these goods are lower. Non-automatic licensing and prohibitions. These measures are normally aimed at limiting the quantity of goods that can be imported, regardless of whether they originate from different sources or from one particular supplier. These measures may take the form of non-automatic licensing or complete prohibitions. So please write up this much and then I take you ahead. Alright friends, once you have finished writing this much, let us move ahead and continue writing further. The next point is financial measures. The objective of financial measures is to increase import costs by regulating the access to and cost of foreign exchange for imports and to define the terms of payment. It includes measures such as advance payment requirements and foreign exchange controls, denying the use of foreign exchange for certain types of imports or for goods imported from certain countries. The next point is measures affecting competition. These measures are aimed at granting exclusive or special preferences or privileges to one or a few limited groups of economic operators. It may include government imposed special channel or enterprises and compulsory use of national services. So please write this much and then I take you ahead. Alright friends, once you have finished writing this much, let us move ahead and continue writing further. Government procurement policies. Government procurement policies may interfere with trade if they involve mandates that the whole of a specified percentage of government purchases should be from domestic firms rather than foreign firms despite higher prices than similar foreign suppliers. Trade related investment measures. These measures include rules on local content requirements that mandate a specified fractional of a final good should be produced domestically. So please write up this much and then I take you ahead. Alright friends, so once you have finished writing this much, let us move ahead and continue writing further. Distribution restrictions. Distribution restrictions are limitations imposed on the distribution of goods in the importing country involving additional license or certification requirements. These may relate to geographical restrictions or restrictions as to the type of agents who may resell. For example, a restriction that imported fruits may be sold only through outlets having refrigeration facilities. So please write this much and then I take you ahead. Alright friends, so once you have finished writing this much, let us move ahead and continue writing further. Restriction on post-sale services. Producers may be restricted from providing after-sales services for exported goods in the importing country. Such services may be reserved to local service companies of the importing country. So please write up this much and then I take you ahead. Alright friends, after writing this much, let us move ahead and continue writing further. That is about administrative procedures. Another potential obstruction to free trade is the costly and time consuming administrative procedures which are mandatory for import of foreign goods. This will increase the transaction cost and discourage imports. The domestic import competing industries gain by such non-tariff measures. For example, specifying particular procedures and formalities requiring licenses, administrative delay, red tape and corruption in customs clearing, frustrating the potential importers, procedural obstacles linked to prove compliances, etc. So please write up this much and then I take you ahead. Alright friends, once you have finished writing this much, let us move ahead and continue writing further. Rules of origin. Country of origin means the country in which good was produced, or in the case of traded service, the home country of the service provider. Rules of origin are the criteria needed by governments of importing countries to determine the national source of a product. Their importance is derived from the fact that duties and restrictions in several cases depend upon the source of imports. Imported procedural obstacles occur in home countries for making available certifications regarding origin of goods, especially when different components of the product originate in different countries. So please write up this whole thing and then I take you ahead. Alright friends, once you have finished writing this much, let us move ahead and continue writing further. Safeguard measures. These are measures by countries to restrict imports of a product temporarily if its domestic industry is injured or threatened with serious injury caused by surge in imports. Restrictions must be for a limited time and non-discriminatory. Next point is embargoes. It is a total ban imposed by government on import or export of some or all commodities to a particular country or regions for a specified or indefinite period. This may be done due to political reasons or for other reasons such as health, religious sentiments, etc. This is the most extreme form of trade barrier. So please write up this much and then I take you ahead. Alright friends, once you have finished writing this much, let us now move ahead and now write the next heading as export related measures. What we have written and understood till this stage was all relating to imports. Now we are discussing export related measures. Ban on exports. Export related measures refer to all measures applied by the government of the exporting country, including both technical and non-technical measures. Export restrictions have an important effect on international markets. By reducing international supply, export restrictions have been effective in increasing international prices. So please write up this whole thing and then I take you ahead. Alright friends, so once you have finished writing this much, let us move ahead and continue writing further. Export taxes. It is a tax collected on exported goods and may be either specific or ad valorem. The effect of an export tax is to raise the price of the good and to decrease exports, thereby resulting in increasing domestic supply. It also reduces domestic prices and leads to higher domestic consumption. So please write up this much and then I take you ahead. Alright friends, so once you have finished writing this whole thing, let us move ahead and continue writing further. Export subsidies and incentives. Countries have developed compensatory measures of different types for exporters like export subsidies, duty drawback, duty free access to imported intermediates, etc. Now before you write anything further, let me first explain one very important term over here, that is duty drawback. Otherwise you will just keep getting confused as in what is this duty drawback. Now let me explain this by conveying an example. Suppose you are importing a particular model of car from Germany. You are a car dealer, you are importing car from Germany. The import duty levied on that car is 20 lakh rupees. Okay, maybe the import duty was 40% and import value is 50 lakhs. So that duty is 40% of 50 lakhs, that comes to 20 lakhs. So the imported goods is now costing you invoice value of 50 lakhs plus import duty of 20 lakhs, that is 70 lakhs is the landed cost in India. Now this duty is levied only if the car is used in India. It may so happen that the car has been imported from Germany and now this car will be sold to some other Asian countries. That means this importer is not using the car in India, is keeping this car just for transit purpose and then going to export this car to some other Asian countries maybe. In such case, that import duties logically should not be levied. Now what happens if this importer is requesting the custom authorities that, see, I did not buy this car for sale in India or use in India, this car is to be exported to another country, say Sri Lanka. In such case, what will happen? Customs department will be asking the importer that, okay fine, we understand this point, you do one thing, you pay the duty, you pay the customs duty, you pay the import duty, and the day you show us the evidence that this car was not used in India and has been exported to Sri Lankan customer, as you have mentioned, we will allow you to take a drawback of the duty that you have paid. That is called duty drawback. So that is one good way to promote exports. Now let you write further. Governments also provide financial contribution to domestic producers in the form of grants, loans, equity infusions, etc., or give some form of income or price support. If such policies are directed at encouraging domestic industries to sell specified products or services abroad, they can be considered as trade policy tools. So please write up this much and then I take you ahead. Alright friends, once you have finished writing this much, let us move ahead and continue writing further. Voluntary export restraints. Voluntary export restraints, VERs, refers to a type of informal quota administered by an exporting country voluntarily restraining the quantity of goods that can be exported out of that country during a specified period of time. Such restraints originate primarily from political considerations and are imposed based on negotiation of the importer with the exporter. The inducement of the exporter to agree to a VER is mostly to appease the importing country and to avoid effects of possible retaliatory trade restraints that may be imposed by the importer. VERs cause, as do tariffs and quotas, domestic prices to rise and cause loss of domestic consumer surplus. So please write up this much and then we move ahead. Alright friends, once you have finished writing this whole thing, let us move ahead and continue writing further under the same heading. Typically, VER is a result of requests made by the importing country to provide a measure of protection for its domestic businesses that produces competing goods. VERs are often created because the exporting countries would prefer to impose their own restrictions than risk sustaining worse terms from tariffs or quotas. Producers in the importing country experience an increase in well-being, though as there is decreased competition, increased prices, profits and employment. In spite of these benefits to producers, VERs reduce national welfare by creating negative trade effect, negative consumption distortions and negative production distortions. So please write up this whole thing, and that will be end of this discussion as well as end of this session.